All right, folks. Brandon Chapman with you today. It's another edition of the Theo Night daily video. Brandon Chapman today. It's February 16th, 2021. As we look at the market today, we are angling down off of the high of the session. We're kind of at a point right now, at kind of maybe an inflection point where maybe the market can start to sell off here. We're going to look at some of the stuff that's gone on today, and again, maybe starting to place a little bit of pressure, and that pressure is either going to yield more upside or maybe more downside. We'll have to see how that works out. Anyway, so as we look at the S&P, we're basically flat on today's session. As we look at the VIX, for all intents and purposes, again, was flat on the session as we're scraping the bottom of the barrel down here close to 20% on the VIX. Again, this places it in a position where you might expect to see a rise in the volatility. And of course, you're seeing that represented by the VVIX, as the VVIX has pretty steadily risen for the last 4 trading sessions, which is essentially emblematic or telling you that they're expecting higher volatility in the future. And again, we're seeing that represented by the skew as well. The skew index currently is at about 137. Anything above 130 is relatively high, and it's indicating what? Tail risk to the market. Markets walk up the stairs and fall out of the window. This is saying the window is pretty high off of the ground and the potential for downside is there. Essentially, what we're telling you is that the market itself is pricing in the potential for significant downside risk. Whether it happens or not, whether it happens soon or not, is anyone's guess. But what are some catalysts that are going to get it there? And one of the catalysts that may put pressure on the market is the TNX. So today we saw the TNX rise almost 0.99. We moved that over a decimal point. We're now pricing at about 1.3% yield on the 10-year. This is the risk-free rate. This prices a lot of stuff out there, and one of which is that it's going to price is mortgage bonds. And as we look at some of the worst performing stocks today in the S&P 500, you'll notice Lennar in there, down big today, 4.6%. Pulte's in the mix there, down 3.73. D.R. Horton down 3.68% today, and down on relatively higher volume. Again, the rise in the 10-year is at least impacting one part of the market, and one of those very sensitive parts of the bond market is mortgage bonds. So mortgage yields going up, placing pressure on some of these home builders. So that's one area that was down today, but it was not necessarily felt more broadly. Some companies actually benefit by a rise in yields, in which case we could look at XLF today up about 1.71%. If we focus on, for example, regional banking, up 2.73%. Well, regional banks typically are more focused on lending. And as we look at the Treasury yield here, the TNX, well, I'm going to add in some other maturities representing the yield curve. And I'm going to take this back to 1-year daily, and I'm going to make this not a percentage, but just looking at straight prices. So as we look at these values, what you'll see is that down here, that's the 3-month T-bill, essentially representing the Fed funds rate. We've got the 5-year, the 10-year, and the 30-year. What you're seeing is that yields are steepening across the way, and the difference in yield is spreading out. Basically doing what? Banks can borrow here and they can lend at higher rates. The steepening of the yield curve is certainly enabling them to lend at higher rates, even giving money to the federal government, buying Treasury bonds. So again, we're in a position right now, at least in the near term, that is relatively favorable for financials itself. In fact, today, if we look at XLF was higher about 1.7%. Bring back my candle chart here, but I'll go back to the trade tab here. XLF did at one point see some rather significant option activity, and that was on the June 35 calls. So you look right here, right? 50,000 bought at 18 June 21.35 call, 50,000 sold at the 38. In essence, what? We're looking at an out-of-the-money long call vertical with the possibility of looking at $38 by the summer. So we'll see whether this plays out. There are risks to seeing a rise in Treasury yields. Number one, basically putting pressure on borrowing costs of companies, meaning that higher yields may impact earnings because of a higher interest expense. It also affects companies in terms of their pricing, right? The relative valuation that they can attain, because all of a sudden their weighted average cost of capital goes up, And meanwhile, their growth rate may not be going up in the same fashion, maybe even going down. And as a function, the multiple with which some of these companies will trade will decline. So there's a lot of potential pressure here that could be borne by a rise in the 10-year Treasury. As we look at towards the top of the page, here are some of the better performing stocks. Of course, there's the reopening trend potential for example, your cruise lines, so RCL, CCL, Norwegian Cruise Lines, kind of topping the list up here along with the SIBO. But as you get just below that, what you'll see, and of course there's tremendous cold and wintry weather in Texas and other parts of the Midwest and other parts of the country. What we're seeing right now is the continued trend in energy companies, namely oil companies like MRO, Apache. Again, every day I call out certain stocks that are seeing unusual option activity. MRO happened last Friday, and other companies. FCX is another one. We're seeing mining-oriented companies. Even, for example, Tech Resources, a coal stock, right? They have a little more diversified operations. As you look here, HollyFrontier, this is one we've been calling out for the last couple of weeks in some of my classes, looking for rotation or outperformance in refiners. HollyFrontier is right at the top of the list here. Mosaic, another stock last week that saw high unusual option activity, breaking out the last couple of days here. So we're seeing, in essence, a commodity cycle kind of returning right now as more interest is being swollen here. So as we look at the S&P specifically, we've had a really, really long run for a while off of our lows here. And in essence, we have various stages of this cycle. This last kind of stage here, what we're seeing is strength in commodities specifically, be it energy, be it agricultural, and even mining. And again, this is very representative of kind of a late cycle surge when you start to see these things. And we'll see how long it can last. But again, right now we're seeing that leadership in very late cycle names, which might give us a hint or a clue. Maybe we're nearing a point where the volatility projections may start to be realized for real. That is not, however, that commodity cycle not extending to precious metals like gold, for example, down 1.6% today. The higher Treasury yields certainly could place pressure on dollar-denominated assets. It's really gold is one of those preeminent in terms of tracking, basically being inverse to the dollar. As we look at the euro/US dollar today, you're seeing a little bit of strength in the dollar moving towards the low of the session. Again, those higher yields may attract a little capital and doesn't necessarily have to go to treasuries. But again, we may further see more selling in treasuries, may pressure stocks, and it may start to yield more of a risk-off scenario that could be very bullish for the dollar in the near term. Finally, one of the things that has certainly kind of held stocks up here or helped them for the most part is the fact that despite the rise in yields, it has not affected every area the same. So for example, if I take HYG, this is a high yield ETF, I'm going to take a ratio with, I'm going to go with LQD first. This is LQD is a corporate investment grade bond ETF. I'm going to take a ratio with IEF, which is a 7 to 10 year treasury. Both these products have similar durations, and as a function, they should respond similarly to changes in interest rates. As we zoom in, what you'll notice here is that the trend of this ratio has been very flat. And despite today's sell-off in treasuries, what you're seeing is the actual ratios actually increased, which showed that LQD is outperforming IEF. What we're not seeing right now is we're not seeing the higher yields getting passed on, not only in terms of a higher borrowing cost because we've raised the risk-free rate, but also potential risk spreads. And we actually saw risk spreads even come in just a little bit with today's selling. As we start to look at high yield market, right? So we're going to go HYG plus, we're going to go IEI because the duration is lower in HYG. As you might expect with selling in treasuries, high yield or junk bonds typically will outperform in more of an inflationary run because they have higher yield, they have shorter duration. However, interesting, right? Today we're seeing this ratio increase in favor of HYG. So despite the selling in treasuries, we did not see a rise in the risk spread of high yield credit. And the question is, what are we looking forward to here in the near future? And as we look at HYG specifically, is there the potential that we might start to see the repricing of risk and more downside potential in HYG? Well, let's look at today's option activity. So we come here to time and sales for HYG, and so I looked at this earlier. There's been additional stuff that's come out. You know, it's 39,000 contracts for the April 16, 21, 83.86 strike. There was another tranche put on later in the day, 10:38 p.m. my time, 83.86. In essence, what's happening? They're buying the 86 put, selling the 83. It's a long put vertical looking at what? A potential retest of the fall lows at around 83. This type of activity is also extending to TLT, for example. And on this product here, as we look at option time and sales on TLT specifically, we're looking at a number of larger trades today. Again, right here, you'll see the 143, 145. That's what's sold here. Sorry, wrong one. The 150, 145, March 19. In essence, so there's a kind of a combination of different activity here, but again, we're seeing a combination of bearish activity and bullish activity here, looking as much of downside here as the 143 puts you'll see down here being bought. Again, looking for more downside. Again, we'll see, right? But the point is, and I kind of botched that up because I'm pointing the wrong ones. Since I looked at it the other day, there's a lot more activity that's popped up here. But the point is that, look, potential downside in TLT, more importantly, that downside may start to pressure high yield credit and specifically more risk assets. And again, we'll look for that tipping point here in the next several days if Treasury yields continue to rise. Well, folks, that's all I got for today. Brandon Chapman, it's February 16th, 2021, and this is our Theo Night report. Thank you.